Hello and welcome to the first video of the lesson, Health Insurance Products, Part 1. Here we will learn about various health insurance products offered by insurance companies in India. Here we will cover the following topics. According to the health insurance regulations of IRDA, health cover means the effecting of insurance contracts that provide for sickness benefits, medical, surgical, or hospital expense, including assured benefits, long-term care, travel insurance, and personal accident cover. Health insurance products available in the Indian market are mostly in the nature of hospitalization products that cover the expenses incurred by an individual during hospitalization. Health insurance is important mainly for two reasons. First, it helps in providing financial assistance to pay for the medical facilities in case of illness. And second, it helps in preserving the savings of an individual which may otherwise be wiped out due to illness. The first retail health insurance product covering hospitalization costs, that is Mediclaim, was introduced by 4 public sector insurers in 1986. Later, the insurance sector was opened up to the private sector players, which led to the entrance of many more companies in the health insurance sector. Today, the health insurance segment has developed to a large extent with hundreds of products offered by almost all general insurance companies, along with health insurers and life insurers. Some important features of health policies are as follows. First, health insurance basically deals with sickness and expenses incurred due to it. Sometimes, the disease contracted by a person could be chronic, long-lasting or critical in terms of impact on day-to-day living activities. Second, various customers with different lifestyles, paying capacity, and health status would have different requirements that need to be considered while designing suitable products to be offered to each customer segment. Customers also desire comprehensive cover while buying health insurance, which would cover all their needs. Third, to achieve greater acceptability and bigger volume, health insurance products need to be kept affordable. And fourth, they should be easy to understand for the customer as well as for the sales team. Irrespective of the product design, health insurance products can be broadly classified into 3 categories. First, indemnity covers. These products constitute the bulk of health insurance market and pay for actual medical expenses incurred due to hospitalization. Second, fixed benefit covers. These are also called as hospital cash, as these products pay for a fixed sum per day for the period of hospitalization. Some products also have a fixed graded surgery benefit incorporated in the product. And third, critical illness covers. These are fixed benefit plans for payout on occurrence of a predefined critical illness like heart attack, stroke, cancer, etc. Products are also designed keeping the target customer segment in mind. The benefit structure, pricing, underwriting, and marketing for each segment is quite distinct. Products classified based on customer segments are individual cover, which is offered to retail customers and their family members. Group cover, which is offered to corporate clients covering employees and groups and their members. And mass policies, which are for government schemes like RSBY covering very poor sections of the population. Thank you. In this next video of the lesson, Health Insurance Products Part 1, we will go through the IRDA guidelines on standardization in health insurance. Based on a common understanding, IRDA issued guidelines on standardization in health insurance in 2013. The guidelines now provide for standardization of definitions of commonly used insurance terms, definitions of critical illnesses, list of excluded items of expenses in hospitalization indemnity policies, claim forms and pre-authorization forms, billing formats, discharge summary of hospitals, standard contracts between TPAs, insurers and hospitals, standard file and use format for getting IRDA for new policies. Thank you. In this next video of the lesson, Health Insurance Products Part 1, we will learn about hospitalization indemnity products. Here we will cover the following topics. An indemnity-based health insurance policy is the most common and highest sold health insurance product in India. The Mediclaim policy, introduced in the 80s by the PSU insurers, was the earliest and the only standard health insurance product available in the market for a long time. Mediclaim still continues to be the largest selling health insurance in the country. Hospitalization indemnity products protect individuals from the expenditure that may incur in the event of hospitalization. In most of the cases, they also cover specific number of days before and after hospitalization, but exclude expenses that do not involve hospitalization. Now we will learn about hospitalization expenses. An indemnity policy pays the insured the cost of hospitalization expenses incurred on account of illness or accident. All expenses may not be payable, as most of the products define the covered expenses, which normally include: first, room, boarding and nursing expenses as provided by the hospital or nursing home. This includes nursing care, RMO charges, IV fluids, blood transfusion, injection administration charges, and similar expenses. Second, intensive care unit, that is, ICU expenses. Third, surgeon, anesthetist, medical practitioner, consultants or specialists' fees. Fourth, anesthetic, blood, oxygen, operation theatre, and surgical appliances charges. Fifth, medicines and drugs expenses. Sixth, dialysis, chemotherapy, and radiotherapy expenses. Seventh, cost of prosthetic devices implanted during surgical procedure like pacemaker, orthopedic implants, infracardiac valve replacements, and vascular stents. Eighth, relevant laboratory or diagnostic tests and other medical expenses related to the treatment. And ninth, hospitalization expenses, excluding cost of organ incurred on donor with respect to organ transplant to the insured. A regular hospitalization indemnity policy covers expenses only if the duration of stay in the hospital is for 24 hours or more. IRDA Health Insurance Standardization Guidelines define pre-hospital expenses that are incurred immediately before the insured person is hospitalized, provided that such medical expenses are incurred for the same condition for which the insured person's hospitalization was required, and the inpatient hospitalization claim for such hospitalization is admissible by the insurance company. Pre-hospitalization expenses could be in the form of tests, medicines, doctor's fees, etc. Post-hospitalization expenses are defined as those medical expenses which are incurred immediately after the insured person is discharged from the hospital, provided that such medical expenses are incurred for the same condition for which the insured person's hospitalization was required, and the inpatient hospitalization claim for such hospitalization is admissible by the insurance company. Post-hospitalization expenses could be in the form of medicines, drugs, review by doctors, etc. after discharge from hospital. Though the duration of cover for pre- and post-hospitalization expenses would vary from insurer to insurer and is defined in the policy, but the most common cover is for 30 days pre- and 60 days post-hospitalization. Pre- and post-hospitalization expenses form part of the overall sum insured for which cover is granted under the policy. An individual health policy also has a provision to take care of expenses incurred for medical treatment taken at home without being admitted to a hospital. However, the condition is that, though the illness requires attention at a hospital, but the condition of the patient is such that he cannot be moved to a hospital or there is lack of accommodation in hospitals. This cover usually carries an excess clause of 3 to 5 days, which means that the treatment cost for first 3 to 5 days has to be borne by the insured. This cover also excludes domiciliary treatments for certain chronic or common ailments such as asthma, bronchitis, chronic nephritis, nephritic syndrome, diarrhea, and all types of dysenteries, including gastroenteritis, diabetes mellitus, epilepsy, hypertension, influenza, cough and cold, and fever. Thank you. In this next video of the lesson, Health Insurance Products Part 1, we will learn about some other aspects of hospitalization indemnity products. Some of the usual exclusions under hospitalization indemnity policies are given below. First, pre-existing diseases. The IRDA guidelines on standardization define pre-existing as any condition, ailment or injury or related conditions for which you had signs or symptoms, diagnosed and received medical advice or treatment within 48 months prior to the first policy issued by the insurer. Most of the times, these are excluded under individual health plans, as otherwise it would mean covering a certainty which poses a high risk to the insurer. Second, weight control programs, supplies or services. Third, cost of spectacles, contact lenses, hearing aids, etc. Fourth, dental treatment expenses that do not require hospitalization. And fifth, hormone replacement, etc. Please refer the book for complete list. Waiting period is applicable for the diseases for which the treatment can be delayed or planned. Depending on the product, waiting period of 1, 2, or 4 years is applicable for diseases such as cataract, hernia, benign prostatic hypertrophy, hysterectomy for menorrhagia or fibromyoma, congenital internal disease, fistula in anus, piles, etc. Let us now learn about different coverage options available under indemnity products. First, individual coverage. An individual insured can cover himself along with family members such as spouse, dependent children, dependent parents-in-law, dependent siblings, etc., as some insurers do not have a restriction on the dependents who can be covered. In such covers, each person insured under the policy can claim up to the maximum amount of the sum insured. Premium will be charged for each individual insured according to his age, sum insured, and any other rating factor. And second, family floater. In this policy, the family consisting of spouse, dependent children, and dependent parents are offered a single sum insured which floats over the entire family. The covers and exclusions under both these policies would be the same. a number of changes to existing coverages and new value-added features have been updated to the basic indemnity cover offered under the earlier Mediclaim product. Some of these changes are as follows. First, sublimits and disease-specific capping. Some of the products have disease-specific capping, such as cataract. A few also have sublimits on room rent linked to the sum insured. Second, co-payment. It is a cost-sharing requirement under a health insurance policy in which the policyholder will bear a specified percentage of the admissible claim amount. It does not reduce the sum insured. Third, deductible. It is a cost-sharing requirement under a health insurance policy in which the insurer will not be liable for a specified rupee amount in case of indemnity policies and for a specified number of hours or days, and in case of hospital cash policies, which will apply before any benefits are payable by the insurer. Fourth, new exclusions. These have been introduced and standardized by IRDA, such as genetic disorders, stem cell implantation, external and durable medical or non-medical equipment, any kind of service charges and surcharges levied by the hospital. Fifth, zone-wise premium. Premium differential has been introduced in certain zones with higher claims cost, such as Delhi and Mumbai. Sixth, coverage of pre-existing diseases. Pre-existing diseases, which were excluded earlier, are specifically mentioned with a waiting period of 4 years. And seventh, add-on covers. Various new additional covers called add-on covers have been introduced by some of the insurers. For example, maternity cover, critical illness cover, coverage for AYUSH, that is Ayurvedic, Yoga, Unani, Siddha, and Homeopathy. The other special features are renewability, coverage for daycare procedures, cost of policy checkup, and duration of pre- and post-hospital coverage that is extended to 60 days and 90 days by most of the insurers. Few indemnity products include value-added covers as listed below. Outpatient cover. As we know, health insurance products in India mostly cover only inpatient hospitalization expenses. Few companies now offer limited cover for outpatient expenses also under some of the high-end plans. Hospital cash. This provides for fixed lump sum payment for each day of hospitalization for a specified period. Normally, the period is granted for 7 days, excluding the policy's deductible of 2/3 of total days. Recovery benefit. Lump sum benefit is paid if the total period of stay in the hospital due to sickness or accident is not less than 10 days. Donor's expenses. The policy provides for reimbursement of expenses towards donor in case of major organ transplant, as per the terms and conditions defined in the policy. Reimbursement of ambulance. Expenses incurred towards ambulance by insured person are reimbursed up to a certain limit that is specified in the schedule of the policy. Expenses for accompanying person. This is intended to cover the expenses incurred by accompanying person towards food, transportation, while attending to insured patient during the period of hospitalization. Family definition. Earlier, primary insured, spouse, dependent children were granted cover. Now there are policies where parents and in-laws can also be granted cover under the same policy. Thank you. In this next video of the lesson, Health Insurance Products Part 1, we will learn about top-up covers or high deductible insurance plans. Top-up policies offer cover for high sums insured over and above a specified amount called threshold. It is also known as high deductible policy. This policy works along with a basic health cover having a low sum insured and comes at a comparatively reasonable premium. For example, individuals covered by their employers can also opt for a top-up cover for additional protection. It can be for self as well as for family and comes in handy in the unfortunate event of high-cost treatment. To be eligible to receive a claim under the top-up policy, the medical costs must be greater than the deductible or threshold level chosen under the plan. These covers are available on individual basis and family basis. In case the top-up plan requires the deductible amount to be crossed at every single event of hospitalization, the plan is known as a catastrophe-based high-deductible plan. However, the top-up plans that allow the deductible to cross past a series of hospitalizations during the policy period are known as aggregate-based high-deductible plans or super top-up cover. Thank you. In this next video of the lesson, Health Insurance Products Part 1, we will learn about Senior Citizen Policy. Here we will cover the following topics. These plans are designed to offer cover to elderly people who are often denied coverage after a certain age, say 60 years. Special attention is paid to diseases of the elderly people in setting coverage and waiting period. Now the entry age is mostly after 60 years and it remains renewable lifelong. The sum insured ranges from Rs 50,000 to Rs 5 lakh and there is variation of waiting period applicable to certain ailments. Also, certain ailments may not have waiting period for a particular insurer, whereas another may have. Pre-existing disease has either a waiting period or capping in some policies. Pre- and post-hospital expenses are either paid as a percentage of hospital claims or as a sublimit, whichever is higher. IRDA has mandated special provisions for insured senior citizens, which are as follows. First, the premium charged for health insurance products offered to senior citizens shall be fair, justified, transparent, and duly disclosed upfront. Second, the insured shall be informed in writing of any underwriting charged over and above the premium, and the specific consent of the policyholder for such loadings shall be obtained before issuance of a policy. And third, all health insurers and TPAs shall establish a separate channel to address the health insurance-related claims and grievances of senior citizens. Thank you. In this next video of the lesson, Health Insurance Products Part 1, we will learn about fixed benefit covers, which include hospital cash and critical illness policy. Here we will cover the following topics. Fixed benefit cover provides adequate protection to the insured persons and also helps the insurer to price his policy effectively for a reasonable duration. In this product, commonly occurring treatments are listed under each system, such as ENT, ophthalmology, obstetrics, gynecology, etc., and the maximum payout for each of these is spelled out in the policy. The insured also gets a fixed sum as claim amount, irrespective of the amount spent by him for the named treatment. The package charges would also include all components of the cost, such as room rent, professional fees, diagnostics, drugs, pre- and post-hospitalization expenses, etc. The package charges could even include diet, transport, ambulance charges, etc., depending on the product. These policies are simple to administer, as only proof of hospitalization and coverage of ailment under the policy are sufficient to process the claim. Some products provide a daily cash benefit along with the fixed benefit cover. The list of treatments covered could vary from around 75 to about 200, depending on the definitions of the treatments in the product. Two important fixed benefit insurance plans are Hospital Daily Cash Insurance Plans and Critical Illness Insurance Plans. Let us now understand Hospital Daily Cash Policy with the help of following features. First, per day amount limit. Hospital cash coverage provides a fixed sum to the insured person for each day of hospitalization. Per day cash coverage could vary from Rs 1,500 per day to Rs 5,000 per day or even more. Second, number of payment days. A detailed list of treatments and duration of stay are stipulated, which limits the daily cash benefit allowed for each type of procedure or illness. Third, standalone cover or add-on cover. The Hospital Daily Cash Policy is available as a standalone policy offered by some insurers, while in other cases, it is an add-on cover to a regular indemnity policy. Fourth, supplementary cover. These policies could supplement the regular hospital expenses policy, as it is cost-effective and provides compensation for incidental expenses and also expenses that are not payable under the indemnity policy, such as exclusions, co-pay, etc. And fifth, other advantages of the cover. From the insurer's point of view, this plan has several advantages as it is easy to explain to a customer and hence can be sold easily. It beats medical inflation as a fixed sum per day is paid for the duration of hospitalization, irrespective of the actual expense. Critical illness policy is a benefit policy with a provision to pay a lump sum amount on diagnosis of certain named critical illness. It is sold as a standalone policy or as an add-on cover to a few health policies. Critical illnesses are major illnesses that could not only lead to very high hospitalization costs, but could also cause disability, loss of limbs, loss of earning, etc., and may require prolonged care post-hospitalization. The critical illnesses covered vary across insurers and products, but the common ones include cancers of specified severity, acute myocardial infarction, coronary artery surgery, heart valve replacement, coma of specified severity, renal failure, etc. A critical illness policy is often recommended to be taken in addition to a hospital indemnity policy. Critical illness offers combination of both covers, that is indemnity for inpatient hospitalization expenses and lump sum payment upon diagnosis of major diseases named in the policy. Critical illness policies are usually available for persons in the age group of 21 years to 65 years. Under these policies, generally 100% of the sum insured is paid on diagnosis of a critical illness. A standard condition that remains in all critical illness policies is the waiting period of 90 days from inception of policy for any benefit to become payable under the policy and the survival clause of 30 days after diagnosis of the illness. The sum insured offered under these policies is quite high, as the primary reason of such a policy would be to take care of the financial burden of long-term care associated with such diseases. Rigorous medical examinations have to be done for persons, especially over 45 years of age, who wish to take the critical illness policy. The insurer may compensate the insured only once for any of the covered diseases of the policy or offer multiple payouts but up to a certain limited number. The policy terminates once the compensation is paid under the policy with respect to any of the insured person. The critical illness policy is also offered to groups, especially the corporates, who take policies for their employees. Here is a quick look at the topics covered in this chapter. Thank you. Hello and welcome to the first video of the lesson, Health Insurance Products, Part 2. Here we will learn about various health insurance products offered by insurance companies in India. Let us begin by understanding long-term care product. Long-term care means all forms of continuing personal or nursing care of people who are unable to look after themselves without a degree of support and whose health is not going to get better in the future. There are two types of plans for long-term care. First, pre-funded plans, which are purchased by healthy insured to take care of their future medical expenses. And second, immediate need plans, which are purchased on a lump sum premium when the insured requires long-term care. The severity of disability decides the quantum of benefit. Bhavishya Arogya policy is basically meant to take care of the healthcare needs of an insured person after his retirement while he pays premium during his productive life. It is similar to taking a life insurance policy, except that it covers future medical expenses rather than death. Some of its key features are as discussed below. Deferred Mediclaim. The policy is a sort of deferred or future Mediclaim policy that provides cover similar to the Mediclaim policy. The proposer can join the scheme anytime between the age of 25 and 55 years. Retirement age. The proposer can choose a retirement age between 55 and 60 years with the condition that there should be a clear gap of 4 years between the date of joining and the retirement age chosen. Pre-retirement period. It means the period starting from the date of acceptance of the proposal and ending with the policy retirement age specified in the schedule. During this period, the insured shall be paying installment or single premium amount as applicable. Withdrawal. In case the insured dies or wishes to withdraw from the scheme, either before the retirement age or after retirement age chosen, the appropriate refund of premium would be allowed depending upon the claims occurred under the policy. Assignment. The scheme provides for assignment. Exclusions. The policy does not have exclusion of pre-existing diseases, 30 days waiting period, and first-year exclusion for specified diseases as in Mediclaim. Group insurance variant. Policy can also be availed on the group basis, in which the facility of group discount is also available. Thank you. In this next video of the lesson, Health Insurance Products Part 2, we will learn about Combi-Products. Health plus life Combi-Products are the products that offer the combination of a life insurance cover provided by a life insurance company and a health insurance cover offered by a non-life or standalone health insurance company. The products are jointly designed by the two insurers and marketed through the distribution channels of both insurers. One of the insurance companies may mutually agree to act as a lead insurer and to play a critical role in facilitating the policy service as a contact point for rendering various services required. The lead insurer plays a major role in facilitating underwriting and policy service. However, the claims and commission payouts are handled by the respective insurer depending on which section of the policy is getting affected. Let us now learn about some important features of Combi-Product. Combi-Products filing shall follow the file use guidelines issued from time to time and should be cleared individually. The product may be offered both as individual insurance policy and on group insurance basis. Free look option is available to the insured and is to be applied to the Combi-Product as a whole. Marketing of Combi-Products can be done through direct marketing channels, brokers, composite individual and corporate agents that are common to both insurers, but not through bank referral arrangements. Specific disclosures have to be made in the proposal and sales literature, especially features in which two insurers are involved, where each risk is distinct from the other, claim settlement issues, matters relating to renewability of both or only one of the covers at the option of the insured, and servicing facilities, etc. Thank you. In this next video of the lesson, Health Insurance Products Part 2, we will learn about package policies. Package or umbrella covers give a combination of covers under a single document. Examples of package policy in health insurance include combining critical illness cover benefits with indemnity policies and hospital daily cash benefits with indemnity policies. In case of travel insurance, the policy offered is also a package policy covering not only health insurance but also accidental death or disability benefits, along with medical expenses due to illness or accident, loss or delay in arrival of checked-in baggage, loss of passport and documents, etc. Thank you. In this next video of the lesson, Health Insurance Products Part 2, we will learn about microinsurance and health insurance for poorer sections. Here we will cover the following topics. Microinsurance products are specifically designed for the protection of low-income people from rural and informal sectors. Microinsurance is governed by the IRDA Microinsurance Regulations 2015. These products come with a small premium and typically the sum is insured is below Rs 2 lakh, as required under the IRDA Microinsurance Regulations 2015. Such covers are mostly taken on the group basis by various community organizations or non-governmental organizations for their members. The IRDA's rural and social sector obligations also require that insurers should sell a defined portion of their policies as microinsurance products to enable wider reach of insurance. Now let us discuss the key features of Jan Arogya Bima policy, which is one of the policies particularly created by PSUs to cater the poorer sections of society. First, this policy is designed to provide cheap medical insurance to poorer sections of the society. Second, the coverage is along the lines of the individual Mediclaim policy. Cumulative bonus and medical checkup benefits are not included in it. Third, the policy is available to individuals as well as to family members. Fourth, the age limit is 5 to 70 years. Fifth, children between the age of 3 months and 5 years can be covered provided that one or both parents are covered concurrently. Sixth, the sum insured per insured person is restricted to Rs 5,000. Seventh, premium qualifies for tax benefit under Section 80D of the Income Tax Act. And eighth, service tax is not applicable to the policy. Another such policy is Universal Health Insurance Scheme. This policy is available to groups of 100 or more families. The benefits of Universal Health Insurance Scheme are as follows. Medical reimbursement. The policy provides reimbursement of hospitalization expenses up to Rs 30,000 to an individual or a family subject to the sublimits. Personal accident cover. Coverage for death of the earning head of the family as named in the schedule due to accident is Rs 25,000. Disability cover. If the earning head of the family is hospitalized due to an accident or illness, compensation of Rs 50 per day will be paid up to a maximum of 15 days after a waiting period of 3 days. Premium. It varies with different segments. For example, it is Rs 365 per annum for an individual, Rs 548 per annum for a family of 5 people, Rs 730 per annum for a family of 7 people, and a premium subsidy for families below the poverty line provided by the government. Thank you. In this next video of the lesson, Health Insurance Products Part 2, we will learn about Rashtriya Swasthya Bima Yojana. Here we will cover the following topics. The government has launched various health schemes, and to extend the reach of health benefits to the masses, it has implemented the Rashtriya Swasthya Bima Yojana in association with insurance companies. Rashtriya Swasthya Bima Yojana has been launched by the Ministry of Labour and Employment, Government of India, to provide health insurance coverage to the below poverty line, that is BPL families. Let us now learn about some features of Rashtriya Swasthya Bima Yojana. First, total sum insured is Rs 30,000 per BPL family on a family floater basis. Second, pre-existing diseases to be covered. Third, coverage of health services related to hospitalization and services of surgical nature which can be provided on a daycare basis. Fourth, cashless coverage of all eligible health services. Fifth, provision of smart card. Sixth, provision of pre- and post-hospitalization expenses. Seventh, transport allowance of Rs 100 per visit. Eighth, the central and state government pays the premium to the insurer. Ninth, insurers are selected by the state government on the basis of competitive bidding. 10th, choice is provided to the beneficiary between public and private hospitals. 11th, the premium has to be borne by the central and state governments in the proportion of 3:1. Central government to contribute a maximum amount of Rs 565 per family. 12th, contribution by the state governments will be 25% of the annual premium and any additional premium beyond Rs 750. 13th, beneficiary has to pay Rs 30 per annum as registration fee or renewal fee. 14th, administrative cost to be borne by the state government. 15th, cost of smart card, that is additional amount of Rs 60 per beneficiary, would be available for this purpose. 16th, the scheme shall commence the operation from the first of the month after the next month from the date of issue of smart card. Thus, if the initial smart cards are issued any time during the month of February in a particular district, the scheme will commence from 1st of April. 17th, the scheme will last for 1 year, that is till 31st March of next year. This would be the terminal date of the scheme in that particular district. Thus, cards issued during the intervening period will also have the terminal date as 31st March of the following year. Thank you. In this next video of the lesson, Health Insurance Products Part 2, we will learn about Pradhan Mantri Suraksha Bima Yojana. Here we will cover the following topics. The recently announced Pradhan Mantri Suraksha Bima Yojana, covering personal accident, death and disability cover insurance, has attracted a lot of interest. The scheme details are as follows. Scope of coverage. All savings bank account holders of age 18 to 70 years in participating banks are entitled to join. Aadhaar would be the primary KYC for the bank account. a person would be eligible to join the scheme if she has one savings bank account. If a person is enrolled in more than one bank, she gets no extra benefits and the extra premium paid will stand forfeited. Enrollment modality or period. The cover shall be for the 1-year period from 1st June to 31st May, for which an option to join or pay by auto-debit from the designated savings bank account on the prescribed forms will be required to be given by 31st May of every year, which is extendable up to 31st August 2015 in the initial year. Premium of Pradhan Mantri Suraksha Bima Yojana is Rs 12 per annum per member. The premium will be deducted from the account holder's savings bank account through auto-debit facility in one installment on or before 1st June of each annual coverage period. However, in cases where auto-debit takes place after 1st June, the cover shall commence from the first day of the month following the auto-debit. Participating banks will deduct the premium amount in the same month when the auto-debit option is given, preferably in May of every year, and remit the due amount to the insurance company in that month itself. The premium would be reviewed based on the annual claims experience, but efforts would be made to ensure that there is no upward revision of premium in the first 3 years. The accident cover for the member will terminate in the following cases. First, on member attaining the age of 70 years. Second, closure of account with the bank or insufficiency of balance to keep the insurance in force. And third, in case a member is covered through more than one account, insurance cover will be restricted to one only, and the other covers will terminate while the premium shall be forfeited. If the insurance cover is seized due to any technical reasons such as insufficient balance on due date or due to any administrative issues, the same can be reinstated on receipt of full annual premium, subject to conditions laid down. During this period, the risk cover will be suspended and reinstatement of risk cover will be at the sole discretion of insurance company. Here is a quick look at the topics covered in this chapter. Thank you. Hello and welcome to the first video of the lesson, Health Insurance Products, Part 3. Here we will learn about various health insurance products offered by insurance companies in India. Let us begin with Pradhan Mantri Jan Dhan Yojana. Pradhan Mantri Jan Dhan Yojana is a financial inclusion campaign for Indian citizens in banking, savings and deposit accounts, remittance, credit, insurance and pension in an affordable manner that was launched by Prime Minister of India, Narendra Modi. The aim of this scheme is to include maximum number of people in the banking mainstream. An account can be opened in any bank branch or business correspondent outlet, also called Bank Mitra. Pradhan Mantri Jan Dhan Yojana accounts are being opened with zero balance. However, if the account holder wishes to get the checkbook, she will have to fulfill minimum balance criteria. Special benefits under Pradhan Mantri Jan Dhan Yojana scheme are as follows. Interest on deposit. Accidental insurance cover of Rs 1 lakh. No minimum balance required. Life insurance cover of Rs 30,000. Easy transfer of money across India. Beneficiaries of government schemes will get direct benefit transfer in these accounts. After satisfactory operation of the account for 6 months, an overdraft facility will be permitted. Access to pension and insurance products. RuPay debit card, which must be used at least once in 45 days. Overdraft facility up to Rs 5,000 is available in only one account per household, preferably lady of the household. Thank you. In this next video of the lesson, Health Insurance Products Part 3, we will learn about personal accident and disability cover. Here we will cover the following topics. A personal accident or PA cover provides compensation due to death and disability in the event of unforeseen accident. Often, these policies provide some form of medical cover along with the accident benefit. In a PA policy, death benefit includes payment of 100% of the sum insured. While in the event of disability, compensation varies from a fixed percentage of the sum insured in the case of permanent disability to weekly compensation for temporary disablement. Weekly compensation means payment of a fixed sum per week of disablement, subject to the maximum limit in terms of number of weeks for which the compensation would be payable. Types of disabilities covered under the policy are: first, permanent total disability or PTD. It means becoming totally disabled for lifetime, such as paralysis of all four limbs, comatose condition, loss of both eyes, hands, limbs, one hand and one eye, or one eye and one leg, or one hand and one leg. Second, permanent partial disability or PPD. It means becoming partially disabled for lifetime, such as loss of fingers, toes, phalanges, etc. And third, temporary total disability or TTD. It means becoming totally disabled but for a temporary period of time. This section is intended to cover the loss of income during the disability period. The client has the choice to select only death cover or death plus permanent disablement, and also temporary total disablement. Let us now understand the concept of sum insured and benefit plan. Sums insured for PA policies are usually decided on the basis of gross monthly income. Typically, it is 60 times of the gross monthly income. However, some insurers also offer on fixed plan basis, without considering the income level. In such policies, sum insured for each section of cover varies as per the plan opted. Being a benefit plan, PA policies do not attract contribution. Thus, if a person has more than one policy with different insurers, in the event of accidental death, PTD or PPD, claims would be paid under all the policies. Next, let us understand the scope of cover and value-added benefits. Scope of cover are policies which are often extended to cover medical expenses and reimburse the hospitalization and other medical costs that are incurred following the accident. Value-added benefits. Along with personal accident, many insurers also offer value-added benefits like hospital cash on account of hospitalization due to accident, cost of transportation if mortal remains, education benefit for a fixed sum, and ambulance charges on the basis of actual or fixed limit, whichever is lower. Thank you. In this next video of the lesson, Health Insurance Products Part 3, we will learn about some other aspects of personal accident and disability cover. Common exclusions under personal accident cover are: first, any existing disability prior to the inception of policy. Second, death or disability due to mental disorders or any sickness. Third, directly or indirectly caused venereal diseases, sexually transmitted diseases, AIDS or insanity. Fourth, death or disability caused by radiation, infection, poisoning, except the case of an accident. Fifth, any injury arising or resulting from the insured or any of his family members committing any breach of law with criminal intent. Sixth, death or disability or injury due to war, invasion, act of foreign enemy, hostilities, civil war, rebellion, etc. 7th, in the event of insured person being a victim of culpable homicide or murder. 8th, death or disability due to childbirth from pregnancy and other consequences. 9th, whether the insured person is participating or training for any sport as a professional or serving in any branch of the armed forces of any country, both in peace and war. 10th, intentional self-injury, suicide, or attempt of suicide. 11th, death or disability arising due to abuse of intoxicants, drugs, and alcohol. And 12th, any injury resulting of traveling in an aircraft or balloon other than duly licensed standard type of aircraft. Certain policies also exclude loss arising out of driving any vehicle without a valid driving license. Family package cover may be granted on the following pattern. First, earning member or persons insured and spouse if earning. It contains independent capital sum insured for each as desired within usual limitations. Second, spouse if she is not an earning member. It usually provides 50% of the capital sum insured of the earning member. This may be limited to a specified upper limit of Rs 1 lakh or 3 lakhs. And third, children between the age of 5 years and 25 years. It usually provides 25% of the capital sum insured of the earning parent subject to a specified upper limit of Rs 50,000 per child. Group personal accident policies are annual policies and its renewal is allowed only on the anniversary. However, non-life and standalone health insurers may offer group personal accident products with term of less than 1 year and also provide coverage to any specific events. Group policies are majority of two following types. First, employer and employee relationship. These policies are granted to firms, associations, etc. to cover named employees and unnamed employees. And second, non-employer-employee relationship. These policies are granted to associations, societies, clubs, etc. to cover named members and members not identified by name. Backbone policy is a specialized PA policy which is designed to provide cover against listed fractures. The important features are as follows. First, fixed benefit or percentage of sum insured mentioned against each fracture is paid at the time of claim. Second, quantum of benefit depends upon the type of bone covered and nature of fracture sustained. Third, compound fracture would have higher percentage of benefit than simple fracture. Fourth, the policy also covers fixed benefit defined in the policy for loss of daily activities such as eating, toileting, dressing, continence, or ability to hold urine or stools, and immobility so that the insured can take care of costs associated to maintain his or her life. And fifth, it also covers hospital cash benefit and accidental death cover. Thank you. In this next video of the lesson, Health Insurance Products, Part 3, we will learn about overseas travel insurance. Here we will cover the following topics. There is always a need of overseas travel insurance because an Indian citizen traveling outside India for business, holidays or studies is exposed to the risk of accident, injury and sickness during his stay overseas. The cost of medical care, especially in countries such as USA and Canada, is very high and could cause major financial problems if a person traveling to these countries were to meet with an unfortunate accident or illness. And To protect against such unfortunate events, travel policies or overseas health and accident policies are available. Such policies are primarily meant for accident and sickness benefits, but most products available in the market gives a range of covers within one product. The covers offered are as follows: accidental death or disability, medical expenses due to illness or accident, loss of checked-in baggage, delay in arrival of checked-in baggage, loss of passport and documents, third-party liability for property and personal damages, cancellation of trips, and hijack cover. The popular policies under overseas travel insurance are business holiday plans, study plans, and employment plans. Overseas or domestic travel insurance policies may only be offered by non-life and standalone health insurance companies, either as a standalone product or as an add-on cover to an existing health policy, provided that the premium for the add-on cover is approved by the authority under file and use procedure. An Indian citizen traveling abroad on business, holiday, or for studies can avail this policy. Employees of Indian employers sent on contracts abroad can also avail it. The cover is granted in US dollars and generally varies from USD 100,000 to USD 500,000. For the section covering medical expenses, evacuation and repatriation, which is also the main section, premiums can be paid in Indian rupees, except in the case of the employment plan, where the premium has to be paid in dollars. The plans are usually of two types: worldwide excluding USA and Canada, worldwide including USA and Canada. Let us now learn about Corporate Frequent Travelers Plan. This is an annual policy whereby a corporate or employer takes individual policies for the executives who frequently make trips outside India. This cover can also be taken by individuals who fly overseas many times during a year. But there are limits on the maximum duration of each trip and also the maximum number of trips that can be availed in a year. An increasingly popular cover today is an annual declaration policy, in which an advance premium is paid based on the estimated man days of travel in a year by a company's employees. Declarations are made weekly or fortnightly on the number of days of travel per employee, and premium is adjusted against the advance. This policy is granted only for business and holiday travels. Common exclusions under the OMP include pre-existing diseases. Hence, persons with existing ailments cannot obtain cover for taking treatment abroad. And the health-related claims under these policies are totally cashless, wherein each insurer ties up with an international service provider with network in major countries who services the policies abroad. Thank you. In this next video of the lesson, Health Insurance Products Part 3, we will learn about the group health cover. Here we will cover the following topics. A group policy is taken by a group owner who could be an employer, an association, or a bank's credit card division, where a single policy covers the entire group of individuals. Group health insurance policies may be offered by any insurance company, provided that all such products shall only be on 1-year renewable contracts. Now let us discuss the features of group policy. First, scope of coverage. The most common form of group health insurance is the policy taken by employers covering employees and their families, including dependent spouse, children, and parents-in-law. Second, tailor-made cover. Group policies are often tailor-made covers which are designed to suit the requirements of the group. Third, maternity cover. One of the most common extensions in a group policy is the maternity cover. A group policy normally has a waiting period of 9 months, and in some cases, even this is waived. Maternity cover would provide for the expenses incurred in hospitalization for the delivery of child, including C-section delivery. This cover is generally restricted to Rs 25,000 to Rs 50,000 within the overall sum insured of the family. Fourth, child cover. In group policies, coverage is given to the babies from day one, sometimes restricted to maternity cover limit and sometimes extended to include the full sum insured of the family. Fifth, pre-existing diseases covered. Several exclusions, such as the pre-existing disease exclusion, 30 days waiting period, 2 years waiting period, and congenital diseases may be covered in a tailor-made group policy. Sixth, the premium charged. This is based on the age profile of the group members, the size of the group, and most importantly, the claims experience of the group. As the premium varies year by year, based on experience, and additional covers, as mentioned above, are freely given to the groups. Seventh, non-employers employee group. In India, regulatory provisions strictly prohibit formation of groups primarily for the purpose of taking out a group insurance cover. It is important to determine the relation of the group owner to its members when group policies are given to other people than employers. Eighth, pricing. In group policies, there is a provision for discount on premium based on the size of the group and also the claims experience of the group. Group insurance reduces the risk of adverse selection as the entire group is covered in a policy and enables the group holder to bargain for better terms. Ninth, premium payment. The premiums could either be paid by the employer or by the group owner, but it is usually on a contribution basis. And 10th, add-on benefits. Tailor-made group policies offer covers such as dental care, vision care, cost of health checkups, and critical illness cover too, at additional premiums or as complementary benefits. Let us now learn about the concept of corporate buffer or floater cover. In most group policies, each family is covered for a defined sum insured, varying from Rs 1 lakh to 5 lakhs and more. Many such situations arise where the sum insured of the family is exhausted, especially in the case of major illness of a family member. In such situations, the buffer cover brings relief, whereby the excess expenses over and above the family sum insured are met from this buffer amount. Amounts are drawn from the buffer once a family's sum insured is exhausted. However, this utilization is usually restricted to major illness or critical illness expenses, where a single hospitalization exhausts the sum insured. The amount that could be utilized by each member from this buffer is also capped, often up to the original sum insured. Thank you. In this next video of the lesson, Health Insurance Products Part 3, we will learn about Special Health Insurance Products. Here we will cover the following topics. Specific covers against the diseases like cancer and diabetes have been introduced in the market by life insurance companies. The cover is long-term, ranging from 5 years to 20 years, and a wellness benefit is also included, which provides regular health checkups paid for by the insurer. There are incentives for better control of factors like blood glucose, LDL, blood pressure, etc., in the form of reduced premiums from second year of policy onwards. On the other hand, a higher premium would be chargeable for poor control. a specific special product is designed with the aim of covering hospitalization complications of diabetes, such as diabetic retinopathy, diabetic nephropathy, eye damage, diabetic foot, and kidney transplant, including donor expenses. This policy can be taken by persons between 26 and 65 years and is renewable up to 70 years. The sum insured ranges from Rs 50,000 to Rs 5 lakhs with capping on room rent. Thank you. In this next video of the lesson, Health Insurance Products, Part 3, we will learn about some key terms that are often used in health policies. They are as follows. First, network provider. It refers to hospitals, nursing homes and daycare centers which are under tie-up with an insurer or TPA for providing cashless treatment to insured patients. Insurers or TPAs normally negotiate favorable discounts on charges and fees from such providers who also guarantee a good level of service. Second, Preferred Provider Network or PPN. Here an insurer has the option to create a preferred network of hospitals to ensure quality treatment and at best rates. Third, cashless service. A cashless service enables the insured to avail the treatment up to the limit of cover without any payment to the hospitals. All the insured has to do is to approach a network hospital and present his medical card as proof of insurance. The insurer facilitates a cashless access to the health service and directly makes payment to the network provider for the admissible amount. Fourth, third-party administrators. These are independent entities who are appointed by insurers for processing and finalizing health claims. TPA's service for health policyholders starts from the issuance of unique identity cards for hospital admissions up to the settlement of claims, either on cashless basis or on reimbursement basis. Thus, health claim servicing is now outsourced by the insurers to the TPAs at a remuneration of 5 to 6% of the premium collected. TPAs are licensed and regulated by IRDA and mandated to provide healthcare services. Fifth, reasonable and necessary expenses. These are the charges incurred while treating a medically necessary condition. These expenses do not exceed the usual level of charges applicable for similar treatment in their locality. This clause provides protection to the insurer against inflation of bills by the provider and also prevents the insured from going to high-end hospitals for treatment of common ailments which could be otherwise done at reasonably low costs. Sixth, notice of claim. Every insurance policy provides for immediate intimation of claim and specified time limits for document submission. In health insurance policies, wherever cashless facility is desired by the customer, intimations are given well before the hospitalization. The time limit for submission of claim documents is normally fixed at 15 days from the date of discharge. IRDA guidelines stipulate that claim intimation or paper submission beyond stipulated time should be considered if there is a justifiable reason for the same. Seventh, hospital. A hospital means any institution established for inpatient care and daycare treatment of sickness or injuries which has been registered as a hospital with the local authorities wherever applicable and is under the supervision of a registered and qualified medical practitioner and also must comply with all minimum criteria as follows. It should have at least 10 inpatient beds in the towns having a population of less than 10 lakhs and 15 inpatient beds in all other places. Qualified nursing staff should be available round the clock. It should have well-qualified medical practitioners in charge round the clock. It should have fully equipped operation theatre of its own where surgical procedures can be carried out. And it should maintain daily records of patients and will make these accessible to the insurance company's authorized personnel. 8th, medical practitioner. A medical practitioner is a person who holds a valid registration from the Medical Council of any state of India and is thereby entitled to practice medicine within its jurisdiction and is acting within the scope and jurisdiction of his license. 9th, qualified nurse. A person who holds a valid registration from the Nursing Council of India or the Nursing Council of any state in India. And 10th, free health checkup. In individual health policies, a provision is generally available to give some form of incentive to claim free health checkups. Many policies provide for reimbursement of the cost of health checkup at the end of 4 continuous claim-free policy periods. Thank you. In this next video of the lesson, Health Insurance Products Part 3, we will learn about some more key terms that are often used in health policies. First, cumulative bonus. Another form of encouraging a claim-free policyholder is providing a cumulative bonus on the sum insured for every claim-free year. This means that the sum insured gets increased on renewal by a fixed percentage, say 5% annually, and is allowed up to a maximum of 50% for 10 claim-free renewals. The insured pays the premium for the original sum insured and enjoys a higher cover. As per IRDA guidelines, cumulative bonus can be provided only on indemnity-based health insurance policies and not on benefit policies except PA policies. Second, malus bonus. As there is an incentive to keep the health policy free of claims, the opposite is called malus. Here, if the claims under a policy are very high, a malus or loading of premium is collected at renewal. Malus is not charged on individual health policies as it is a social benefit policy. Third, no claim discount. Some products provide for a discount on premium for every claim-free year instead of a bonus on sum insured. Fourth, co-payment. Co-payment is the concept of the insured bearing a portion of each and every claim under a health policy. This could be compulsory or voluntary, depending on the product. Co-payment brings in a certain discipline among the insured to avoid unnecessary hospitalizations. Fifth, deductible. In health policies, it is the fixed amount of money that an insured is required to pay initially before the claim is paid by insurer. It is also called as excess in health policies. Deductible may also be specified number of days or hours in case of hospital cash policies, which will apply before any benefits are payable by the insurer. Sixth, room rent restrictions. Today, several products place a restriction on the category of room that an insured chooses by linking it to the sum insured. This means that if one prefers luxury treatment at high-end hospitals, then the policy should be purchased for high sums insured at appropriate premium. Seventh, renewability clause. The IRDA guidelines on renewability of health insurance policies makes lifetime guaranteed renewal of the health policies compulsory. An insurance company can deny renewal only on the grounds of fraud or misrepresentation or suppression by insured or on his behalf, either in obtaining insurance or subsequently in relation thereto. Eighth, cancellation clause. The cancellation clause is also standardized by regulatory provisions, and an insurance company may at any time cancel the policy only on grounds of misrepresentation, fraud, non-disclosure of material fact, or non-cooperation by the insured. A minimum of 15 days notice in writing by registered AD should be sent to the insured at his last known address if required. When a policy is cancelled by the insurer, the company shall return a proportion of the last premium corresponding to the unexpired period of insurance, provided no claim has been paid under the policy. And in the event of cancellation by the insured, premium is refunded on short period rates. That is, insured would receive refund of premium for a percentage less than the prorates. Also, if a claim is made, no refund would be given. 9th, free look period. It is a period where a new insurance policy owner is able to terminate the contract without penalties. The customer can return it and get a refund subject to the following conditions. This applies only to life insurance policies and to health insurance policies with tenure of at least 1 year. The customer must exercise this right within 15 days of receiving the policy document. He has to communicate the same to the insurer in writing, and the premium refund will be available only if no claim has been made on the policy and will be adjusted for expenses incurred by the insurer, stamp duty charges, and proportionate risk premium for the period on cover. And 10th, grace period for renewal. As per IRDA guidelines, a 30 days grace period is allowed for renewal of individual health policies. All continuity benefits are maintained if the policy is renewed within 30 days from expiry of the earlier insurance. Here is a quick look at the topics covered in this chapter. Thank you.